Welcome to Breaking News to Trading Moves. Today we're looking at a pretty specific strategic move in the European delivery market, one that has traders and analysts really paying close attention.
It really does. I mean, this is a classic case of a big corporate strategy move colliding with, well, market reality.
And it's pretty clear-cut. We have a headline, a set of financial targets, and then, a list of who could win and who could lose from this.
Exactly.
So let's get right to it. The headline is that Uber, that's ticker UBER, is expanding its Uber Eats business into 7 new European markets.
And this is planned for 2026.
Right, 2026. And the countries are Austria, Denmark, Finland, Norway, the Czech Republic, Greece, and Romania.
So it's a really broad geographic spread. You've got, the high-cost Nordic markets, but also the emerging growth markets in Central and Southeastern Europe. It's an aggressive push.
And they're putting a hard number on it, which I found notable. Uber is expecting this expansion to add about $1 billion in gross bookings over 3 years.
And that's on top of their recent move to acquire Getir's delivery business in Turkey.
So it's part of a bigger picture.
Absolutely. If you step back, you see the pattern. It's about filling in the white space on the map.
Okay, but I have to ask the obvious question here. Why these markets, and why now? I mean, places like Austria, Norway, they aren't empty. There are local players, so why does this matter beyond just, adding more flags to the website?
That's the right question to ask. And it's not about vanity metrics. It's what we'd call a scale play. And in this business, scale is almost a matter of operational physics.
Operational physics. Okay, you have to break that down for me.
So when you open a new market, you're not just adding top-line revenue. You're trying to improve 3 specific things: merchant density, courier utilization, and your subscription attach rate.
Okay, let's take those one by one. Merchant density.
Right. Think of it as the empty lobby problem. If a user in, say, Oslo opens the app and sees only 3 pizza places, what do?
They close the app.
They close the app. That's churn. You need a high density of restaurants just to make the platform worthwhile. But density also does something else. It shortens the last mile.
Because if there are more restaurants, the average drive from the kitchen to the customer is just shorter, statistically.
Exactly. Shorter distances, faster delivery, happier customers. But that feeds right into the second point, which is the real economic engine: courier utilization.
How busy the drivers are.
How busy the drivers are. Imagine a courier in Vienna. If they drop off a rideshare passenger and there's no food delivery waiting nearby, that courier is idle. And idle time is the absolute killer of unit economics.
So you're paying them for time that isn't making you money.
You are. So
Okay.
if you can add Eats to a market where you already have rides, that driver can switch from moving a person to moving, a burrito. The whole network gets more efficient.
Right, because you're filling the gaps in their schedule.
You're filling the gaps. It allows for things like batching, picking up 2 orders at once. When utilization goes up, the cost per trip goes down.
And that's when the margins start to look a little healthier.
Precisely. Which brings us to that third lever, the subscription angle, the attach rate.
We're talking about Uber One.
We're talking about Uber One, the membership. See, the holy grail here is forming a habit. When you get someone to subscribe, 2 things happen. First, they just spend more money. They order more often.
Because they want to feel like they're getting their money's worth from the monthly fee.
Of course. But the second thing, and for a trader this is key, is that the cost to acquire their next order, the CAC, drops to basically 0. You don't have to run ads to get them to order dinner. They're already in the ecosystem.
So you're lifting their order frequency. Instead of using the app once a month for a ride, maybe now you use it once a week for food.
And that's the whole goal. You lift frequency, you improve the economics, and suddenly that $1 billion in new bookings looks, well, very achievable.
Okay, that makes sense as a strategy. But let's get to the trading moves. If this works, who benefits? Let's start with the most obvious category of winners: the global delivery platforms themselves.
Obvious names here, yeah. Uber itself, so UBER, and also DoorDash, ticker DASH.
Okay, Uber makes sense. But tell me why they have an edge over a local competitor in, say, Prague.
It's that cross-sell advantage we just touched on. It's huge. Uber already has a database of ride-hailing customers in a lot of these places. It is so much cheaper to market food delivery to them than it is to go find a brand new customer from scratch.
Right, that customer acquisition cost again. A local player has to go pay Google or Meta.
A lot of money. Uber just sends a push notification to someone who's already in their app. That is a structural advantage on the margin side.
But you also mentioned DoorDash, ticker DASH, as a winner. Now, this is Uber's news. Isn't this just more competition for them?
You'd think so at first glance, but you have to think about how investors see the whole sector. DoorDash has a very strong playbook for international markets, especially in Europe, through their acquisition of Wolt.
Wolt, the Finnish company they bought. So they're already established in the Nordics.
Very established. So when investors see a big player like Uber making a move like this, it validates the whole market. They're looking for what they call repeatable expansion.
So Uber's news tells the market, hey, there's still a lot of growth to be had here in Europe.
It validates the model. It signals that this is a winner-takes-most kind of market. The biggest players with the best networks, they tend to win because they can offer better selection, faster times, and those membership perks.
So if you're holding DAH, you're not panicked. You're actually seeing this as confirmation that the market is healthy and growing.
Exactly. It reinforces the whole thesis that these are global platforms, not just local apps.
All right, let's move to a second category of winners. This one is maybe less obvious to a consumer, but it makes perfect sense for a trader. The payment networks.
Oh, absolutely. Here we're looking at Visa, ticker V, MasterCard, MA, and also PayPal, PYPL.
Explain the logic. Why does Visa care if someone in Copenhagen orders a kebab?
Because of the type of spending it is. We call it high-frequency card-on-file spending.
Card on file. Meaning my card is saved in the app, I just tap a button and the payment is invisible.
Exactly. It removes all the friction. But think about the volume. You buy a TV maybe once every few years. You might buy a plane ticket once a year. But you eat every single day.
The velocity of transactions is just so much higher.
So much higher. If Uber succeeds, that's millions of small incremental transactions. And all that transaction flow has to ride on someone's rails.
And that's Visa or MasterCard?
It is. Whether it's a tourist using a U.S. card in Greece or a local using their domestic card, the payment processors take a tiny slice of every single one of those $1 billion in bookings.
So they're kind of like the toll road operators for this whole expansion.
That's a perfect way to put it. They benefit from the volume, and they don't really care which platform wins. They're the neutral winner.
Let's move to our third group of winners, restaurant brands. And you're saying specifically the big global ones.
Yes, the global giants. McDonald's, ticker M-ED. Yum. Brands, that's YUM, which owns KFC and Pizza Hut. And Domino's, DPZ.
Why do they benefit more than the local mom and pop shop? Is this another big get bigger situation?
It is, and it comes down to integration. First, it's just easier to onboard them. A chain like McDonald's has standardized menus, standardized systems, and dedicated corporate teams.
They can just flip a switch and be live in 7 countries at once.
Pretty much, yeah. A local place might struggle with getting the tablet set up with the menu photos. McDonald's is just plug and play. The second thing is brand pull.
Ah, familiarity.
Right. When a user opens a new app, they look for names they recognize. It builds trust. McDonald's is like an anchor tenant in a mall.
So if I open Uber Eats for the first time in Bucharest and I see McDonald's, I think, okay, this app is legit.
And finally, delivery just drives frequency for these brands. It opens up a whole new revenue stream for a location in a secondary city in Romania that maybe didn't exist before. It turns that kitchen into a little distribution hub.
It makes their physical locations more productive.
Exactly. A better return on their invested capital.
So the big get bigger. But now let's flip the script. Every trade has another side. Who are the losers here? Or at least, where are the big risks?
And this is where it gets a little more complex. Because our first category of losers, well, it includes the exact same companies we just called winners.
Wait, the global delivery platforms?
Mm-hmm.
UBERDHH, and I see you've added Instacart ticker cart here. How can they be winners and losers?
It's all about the time frame. Long term, they're probably winners if this works. But in the short term, when a major player expands this aggressively, the whole category enters what we call incentives mode.
The promo wars. I knew it.
The promo wars. Uber can't just show up in Finland and expect orders. They have to offer free delivery, 10 euros off your first order, buy one, get one deals. They have to buy market share.
And they have to pay the couriers too, right?
Yeah.
Before there are even enough orders to keep them busy.
Absolutely. Courier bonuses to get them on the road, consumer discounts, special deals for merchants to get them to sign up. All of that is upfront cash burn.
And that puts pressure on the take rate, the cut that the platform actually keeps.
It crushes take rates, and it puts pressure on profitability expectations. Investors might look at the near-term margins and see a dip. That's the loser argument. You're trading today's margin for tomorrow's growth.
Okay, that makes sense. It's the cost of growth.
Yeah.
What about the restaurants? We said the big chains win. Who loses?
The restaurant operators with thinner margins. So think about tickers like Brinker International, EAT, or Dine Brands, which is DIN.
So Chili's, Applebee's, IHOP, the sit-down casual dining places.
Correct. And here's their problem. They don't have the massive scale of a McDonald's. If competition for delivery drives up commissions, or if the app's algorithm basically forces them to offer discounts to stay visible, it just squeezes their margins.
And restaurant margins are already razor thin.
Extremely thin. So if you're forced to discount your food by 20% just to get the order, and then you pay a commission on top of that, the economics can get ugly very fast.
So for them, delivery isn't always a good thing. It might actually hurt their profitability if they're not careful.
It can be. It might cannibalize their more profitable dine-in business and replace it with lower margin delivery. That's a dangerous mix.
That's a tough spot. Okay, our final category of losers is one I wouldn't have immediately thought of. Traditional grocery and convenience retailers.
Yeah, this is more of a share of wallet story. We're looking at names like Kroger, ticker KR, and Walmart, WMT.
How does me ordering a burger affect Walmart? I still need to buy milk from them.
It's not about the milk. It's about the grab-and-go occasion.
Yep.
Think about it. It's a Tuesday night. You're hungry. You have a choice. You can drive to the grocery store for a prepared meal or a frozen pizza, or you can tap a button.
And have hot food delivered. It's a substitution.
It's a subtle one, but it's a real shift in spending. More delivery availability pulls spending away from the grocery store and toward prepared food.
So if I can get a hot meal in 20 minutes, I'm less likely to go grab a rotisserie chicken from the store.
Exactly. It challenges the convenience part of the retailer's value proposition. So for investors, a stronger food delivery ecosystem is seen as a headwind for the high-margin prepared food sales at those big retailers.
It's that friction point again. The app removes friction, and the store still makes you get in your car.
And in this economy, the path of least resistance usually wins that incremental dollar.
Okay, so let's bring it all together for the listener. What's the summary here?
The bull case is really about three things: network density, subscription growth, and better unit economics over time. You're betting that Uber can execute its playbook in these new countries.
And the bear case.
The bear case is all about the cost. The launch incentives, the operational costs, it all creates near-term margin noise. Revenue might go up, but profits could take a hit for a few quarters.
So what should we be watching? What are the key metrics?
You need to watch the delivery segment margins very closely. If they dip a lot, the expansion is proving expensive. Also, watch the membership growth numbers. Are people in these new markets actually signing up for Uber One? And finally, just listen to the company commentary on promo intensity in Europe.
So it all comes down to that tension between the scale play and the promo wars. Will these launches require incentives that pressure margins for longer than anyone expects?
That's the core question you have to ask yourself. The move is bold, but the execution has to be just about perfect to protect that bottom line.
All right. Before we go, just a quick reminder for everyone listening, this is not financial advice or buy or sell recommendations. This is purely the opinion of the author. Thanks for listening to Breaking News to Trading Moves. We'll catch you next time.